Some great news then, both the Dow and the S&P ending 3-month record highs. How sustainable is this, do you think?
Well, I think my sense is that, clearly there's enough there in terms of the earnings-driven element of the market, the actual ability of the market to actually respond to better news on corporate earnings over the next 6 months to take the market higher. But we are in a situation here again where we're looking at the possibility of a shift in interest rate sentiment. The rating of markets at the moment is not cheap. And clearly there is a measure of complacency, but really for the medium term, and by that in this context I mean basically 6 to 12 months, we do still think equities is where it's at.
And do you think that this could derail things and force Yellen to become more hawkish perhaps?
No, the idea, the sense is that the labour market is tightening. The report yesterday for June unambiguously pointed to that. All the measures of slack in the labour market have tightened, but there's still substantial slack in the economy. The participation rate should respond in some way to the recovery. Wage growth is still modest at only 2% year on year. So Chairperson Yellen would actually be, I think, convinced still, as she has been, that there is enough there to support a accommodative policy, a highly accommodative policy, into the middle of 2015.
Okay, and let's take a look then at the Forex implications of this. How is this going to affect the dollar? And coupled with Draghi's comments yesterday at the ECB, could this make for a weaker euro perhaps?
Yeah, we are dollar bulls. We think the divergence in monetary policy in the US and of course in the UK will support those currencies. The return of carry and clearly obviously the distinct difference in stance between the US and the UK on the one side and Eurozone. We do not believe at this stage that the ECB is necessarily done. We're still looking at the 40% probability of QE in or about the end of the year, early 2015. In any event, as Draghi pointed out yesterday, interest rates in Europe will remain low for an extended period of time, and I say they have not discounted further action. The economic revival is gradual. It looks to be sustained, but it cannot be described as being robust.
And how will this affect the equity markets then and investor thinking going forward?
Well, we have a preference for Eurozone, and in that instance we feel that the move from recession to recovery this year in Europe will be provide a fill-up to European earnings. That will be supported by a weaker euro. We're looking at about 126 in 12 months' time against the US dollar, and that should lead, I think, to upside surprises over the next 12 to 18 months in European earnings. So in terms of where it's at, again, the earnings-driven cycle, we think the good news really will particularly focus on the returns from Eurozone equity markets.